Most people believe wealth is destroyed by big mistakes, bad investments, market crashes, or financial crises. But the truth is more subtle. Wealth is often destroyed by a small, hidden mistake repeated over time. This mistake does not feel dangerous. It seems harmless and even logical, but slowly, it prevents growth, reduces returns, and keeps people from building long-term financial stability. The hidden mistake is inconsistency. Many investors start strong, but they do not stay consistent. They invest when they feel confident and stop when markets become uncertain. This breaks the compounding process. Wealth requires steady action over time, not occasional effort. Another part of this mistake is emotional decision-making. Fear and excitement influence actions more than logic. Investors buy when prices are high and sell when prices are low. This repeated behavior quietly destroys long-term returns. Trying to time the market also contributes to this mistake. Waiting for perfect conditions leads to missed opportunities. While investors wait, their money is not growing. Time in the market is more valuable than perfect timing. Ignoring small losses is another factor. Fees, inflation, and poor decisions may seem minor, but over time they accumulate. These small losses reduce compounding and limit overall growth. Another issue is lack of discipline. Even good strategies fail without consistent execution. Discipline ensures that investing continues regardless of emotions or external conditions. Another hidden part of this mistake is stopping investments during difficult periods. When markets fall, many investors pause or withdraw money to avoid further losses. This reaction feels safe, but it locks in losses and removes the chance for recovery. Markets historically recover over time, but only those who remain invested benefit from that growth. Inconsistency during downturns quietly damages long-term results. Many investors also underestimate the power of compounding. At first, growth seems slow and almost invisible. This leads to frustration and doubt. However, compounding accelerates over time, turning small gains into large outcomes. Those who interrupt the process by stopping or changing strategies never reach the stage where growth becomes significant and noticeable. Another mistake is failing to reinvest profits. Dividends, interest, and gains are often spent instead of reinvested. This interrupts the compounding cycle. Reinvesting returns allows money to generate more returns, creating exponential growth over time. Without reinvestment, progress becomes limited and far less effective. Lack of diversification also contributes to this hidden mistake. Concentrating too much money in one investment increases risk. If that asset performs poorly, the entire portfolio suffers. Diversification spreads risk and supports more stable growth, reducing the impact of individual losses on long-term wealth. Another factor is overtrading. Many investors believe that frequent activity improves results. In reality, constant buying and selling increases costs and leads to poor timing decisions. Each trade reduces returns, making it harder for wealth to grow over time. Ignoring fees quietly destroys wealth. Management fees, commissions, and hidden costs reduce returns every year. Even small percentages make a large difference over time. Keeping costs low allows more money to remain invested and grow through compounding. Another issue is waiting too long to start investing. Many people delay action because they want more money or better conditions. This delay reduces the time available for compounding, making it harder to build significant wealth later. Lifestyle inflation also plays a role. As income increases, spending increases as well. Instead of investing more, people use extra money for short-term comfort. This prevents wealth accumulation and slows long-term progress. Another hidden mistake is lack of clear goals. Without a defined objective, investing becomes inconsistent. People lose focus and change direction frequently, which reduces effectiveness. Emotional reactions to news often lead to poor decisions. Headlines create urgency and fear, pushing investors to act impulsively instead of following a plan. Another problem is not increasing investments over time. As income grows, contributions should grow as well. Keeping them the same limits growth. Overcomplicating strategies leads to mistakes. Simple, consistent plans are easier to follow and usually produce better results. Another hidden mistake is focusing too much on short-term results. Many investors check their portfolios daily and react to every small change. This behavior creates stress and leads to unnecessary decisions. Short-term movements are unpredictable and often irrelevant to long-term growth. By reacting to them, investors disrupt their strategy and reduce potential returns, preventing compounding from working effectively over time. Another issue is not having a clear plan. Without a structured approach, investing becomes random and inconsistent. Decisions are based on emotions, opinions, or temporary trends. A clear plan defines contributions, asset allocation, and long-term goals. This structure helps maintain discipline and consistency, which are essential for building wealth over time. Many people underestimate the importance of starting early. They believe they can invest later and still achieve similar results. However, time is the most valuable factor in investing. Starting early allows compounding to work for a longer period. Delaying even a few years can significantly reduce final outcomes and make the process much more difficult. Another mistake is focusing only on earning more money instead of investing it. While higher income helps, it does not create wealth on its own. Without investing, money does not grow. Many people increase their income, but also increase their spending, staying in the same financial position over time. Emotional reactions during market downturns often cause major losses. Fear leads investors to sell in order to avoid further decline. However, selling during these periods locks in losses and prevents recovery. Staying invested allows participation in future growth and protects long-term results. Another costly behavior is constantly changing strategies. Investors move from one idea to another, chasing better results. Each change resets progress and prevents compounding from building momentum. Consistency is essential for long-term success, and frequent changes reduce effectiveness. Ignoring inflation quietly destroys wealth. Even if money appears stable, its purchasing power decreases over time. If investments do not grow faster than inflation, real value is lost. Understanding this effect is critical for protecting long-term financial growth. Another mistake is relying on luck instead of discipline. Some investors hope for one successful opportunity to change everything. While this may happen occasionally, it is not reliable. Wealth is built through consistent effort and planning, not chance. Stopping investments during downturns reduces future gains. Lower prices often provide better opportunities, but fear causes many investors to pause or withdraw. Continuing to invest during these periods strengthens long-term results. Another problem is not reviewing investments periodically. Without review, portfolios can become unbalanced or misaligned with goals. Regular adjustments help maintain stability and manage risk effectively. Failing to build strong financial habits limits growth. Investing should become a routine, not an occasional decision. Habits create consistency, and consistency drives long-term success. Lack of patience prevents wealth from developing. Many investors quit before results become visible. Staying consistent over time allows compounding to work and produces meaningful outcomes. Another hidden mistake is not automating your investments. When investing depends on memory or mood, it becomes inconsistent. Some months are skipped, others are delayed. Automation removes this problem completely by creating a steady system. Regular automatic contributions ensure that your strategy continues without interruption, even during busy or uncertain periods, strengthening long-term growth. Many investors also waste unexpected income. Bonuses, gifts, or extra earnings are often spent immediately on short-term desires. However, these moments are powerful opportunities to invest more. Adding this income to your portfolio accelerates compounding and significantly increases long-term results. Lack of long-term planning quietly destroys wealth. Without a clear vision, financial decisions become reactive instead of strategic. Investors move from one idea to another, never building a stable foundation. Long-term planning creates direction and helps maintain consistency over time. Constantly changing strategies prevents progress. Each time you switch your approach, you reset your results. Compounding requires time and stability to work effectively. Investors who frequently change plans never allow growth to build, limiting their long-term success. Focusing too much on short-term performance creates stress and poor decisions. Daily price movements are unpredictable and often irrelevant. Reacting to them leads to unnecessary changes that reduce long-term returns. Lack of discipline is one of the biggest hidden mistakes. Even the best strategy fails without consistent execution. Discipline ensures that investing continues regardless of emotions, distractions, or market conditions. Not understanding compounding limits growth. Returns generate additional returns over time, but only if investments remain consistent. Interrupting this process reduces its power significantly. Ignoring small habits reduces long-term success. Small actions, repeated consistently, create powerful results. Saving and investing regularly builds a strong financial foundation. Seeking shortcuts often leads to losses. Quick gains are attractive, but they usually involve high risk. Sustainable wealth is built through steady and disciplined investing. Quitting too early stops progress. Many investors abandon their strategy before results become visible. Persistence is required for compounding to take effect and produce meaningful outcomes. Not adapting gradually can reduce effectiveness. While consistency is important, small adjustments help maintain balance as income and goals change over time. Expecting fast results leads to disappointment. Investing is a long-term process, and those who expect immediate success often quit too soon. Comparing yourself to others creates pressure and poor decisions. Every investor has a different path. Staying focused on your own strategy is key. Fear of making mistakes prevents action. Waiting for perfect conditions leads to lost time and missed opportunities that cannot be recovered. Overreacting to market changes leads to unnecessary losses. Staying calm and following a plan protects long-term growth. Not increasing investments over time slows progress. As income grows, contributions should grow as well to accelerate wealth building. The real difference between investors is behavior. Discipline and consistency create wealth, while emotional decisions destroy it over time. The hidden mistake that destroys wealth is not one big action, but many small ones repeated daily. Fix these habits, and your financial future will change completely.